Paul, welcome to Wealth Talk.
Thank you, Chris. Good to be here.
Good to have you on. I can't believe it's taken so long for us to get you here, Paul. Why don't you just, Kevin and myself just shared a few words, but why don't you share a little bit about your history with WealthBuilders so far?
Sure. Kevin and I have been working together for a long time now, and my role at WealthBuilders is a SaaS director. So I head the side of the business that effectively helps people to create a particular type of pension, and I'm sure for the regular listeners of the podcast, they'll be familiar with SSAS or what we call a director's pension. So I head the team that takes the business owners that we work through that exciting journey of creating a pension that they're genuinely in the driving seat of and able to really influence how their pension wealth works. But yeah, I've been doing it for a long time. As I say, Kevin and I have been working together for I believe this is our 11th year anniversary, in fact, coming up in August. So
congratulations.
Long time.
Hopefully we can get together and celebrate and have some cake.
That would be great. Yeah, well, when we come out of lockdown and we're allowed to see more than just 6 people, that would be great. Get out and get the team together and, have a cake and a celebration.
So the pension pillar, Paul, perhaps not the sexiest of the pillars, but absolutely one of the most powerful ones if you know how to make it work for you, would you say?
Oh, absolutely. I'd 100% agree with that. And certainly I would say the most common pillar, probably outside of home equity and making your home pillar work, I would say most people have some wealth in the pension pillar somewhere, even if they've forgotten about it in truth, which of course a lot of people have. But yeah, a hugely influential pillar in building wealth, if you know how to make it work.
So let's talk about that, Paul, because obviously, we speak to people every day, don't we, and find out about their pensions. And some people might just have a few £1,000s. Some people might have, £1 million plus, significant pensions and everything in between. So, can anyone really make their pension work harder? Are there some basic rules that anyone can apply?
I think the simple answer to that is everyone can make their pension work harder if they know what to look for and they know how to do that. And that ranges from, I suppose, at the very simple end of the spectrum to really just taking control of the things that you can take control of when you have simpler pensions that are all invested in the stock market. And really that means taking hold of and controlling the costs of investing, all the way up to the sort of super sexy end, if I can call it that, of the pension world, which is SSAS, that director's pension, where you can and are genuinely sat in the driving seat of what is the highest performance pension vehicle available.
Well, let's go into some detail in those perhaps in a short while. But I just want to reflect, because we're in a kind of theme at the moment, Paul, of going through the pillars and looking at obviously the impact of the coronavirus and how it's affected people's wealth and people's mindset as well. Because we talk often about people having one statement a year with their pension, and it arrives and kind of look at it and stick it in a drawer and forget about it again. That typically seems to be the case because it's not the most exciting topic. And people, as you mentioned, just feel they have no control over their pension. But over the last 3 months, we've seen that the markets, which, majority of pension money is invested in the market, the markets have, been significantly affected. And therefore, people may have been looking and thinking, wow, okay, I'm kind of banking on my pension looking after me when I get older, and it's gone down 30% or whatever it may have been over the last few months. People maybe now are thinking about their pension a little bit more and saying, well, do I have more control? Is there something more I can do about this? So what's your perception over the last few months? What have you been seeing from people you've been speaking to?
Well, it's interesting. This is the biggest sort of stock market wobble we've probably had since 2007, 8, 9, and albeit a much more condensed version of the crash in 08, because it's dropped significantly quicker and actually come up to something resembling a normal level in a much, much quicker time frame too. We don't really know what the long-term impact, of course, is. We're still in the COVID pandemic right now, albeit, thankfully things aren't quite as bad as they were even just a month ago. But I think, what I'm seeing, and really what I hope people are seeing, is that taking control of your pension wealth really means reviewing what your long-term strategy is, and really not just defaulting back to the same old 6-monthly statement or yearly statement that goes in the drawer and not really having any relationship with their pension. And I think it's like anything, Kevin and I have been saying for years to people that, if you're a property owner, would you buy a property and then never go and see it or look at it or think about it for 20 years? Yeah, you just wouldn't do it, would you? You would maintain it. You would make sure it was still in a good state. You would want it to be working hard and tenanted and rented and working for you. But people do that with their pensions. And as you said, Chris, largely because they're not exciting. People don't feel connected with them. And a key element to making your pension work, whatever your pension looks like, is taking some degree of control and responsibility, I think. And there is one thing that everyone can do to certainly take control of the broader performance of their pension. Nobody can predict a global pandemic. Nobody knew that COVID was going to happen. And, we're looking back now and I'm sure lots of people will have learned a lot. But, the one thing that you can control in all pensions is cost. And, I'm sure you've probably talked about this in other podcasts, but, there are ways of investing in the markets where you can invest for a very, very low cost. And therefore, to an extent, you can dictate and control the long-term performance of the pension, which means that the impact of short-term blips like this in the longer term have much less of a negative impact.
What would be an example there, Paul, of a lower cost?
Well, a good example would be, I guess there are lots of different types of pensions, but stock market-based pensions generally tend to have at least 2 different layers of cost. They'll have the platform provider, the pension provider's cost for administering their pension for them and giving them access to the funds. And then you would have some fund costs. Now, typically, most people's pensions are, sort of 1.5–2% all in. If you factor in that that there are usually fund manager costs and IFA costs in many cases, and that's not to say those costs aren't important, because lots of IFAs provide an important service, but you can definitely look to find a lower cost pension provider. And especially if you have an older pension, nowadays the cost of actually owning a pension and the ongoing fees for that have dropped, and there are lots of low cost, functional, flexible pensions available now.
And technology is helping with this, and apps.
Absolutely. There's a huge number of really technologically driven pension providers now that are really sort of pioneering a new era of basic personal pensions, for example, where you can get access to great features, access 24 hours a day on an app. You can make changes to your pension either on your own or with the guidance of an IFA. And that's all very quick and easy to do. And they tend to be lower cost.
And this simply wasn't there, in comparison in 2008 when the word annuities was much more prominent than it is today.
Well, it was the default for so many years. People worked their whole lives and then they retired, and their retirement was they would buy an insurance product called an annuity, which would give them an income for the rest of their life, and it was guaranteed. But of course, they would have to forfeit the growth and the capital they built in their pension. And so in many cases forfeited a legacy. Back in 2008, when the last big crash happened, drawing income from your pension in a flexible way was very, very new and definitely not anything like it looks like today. Fast forward to today, and it's drawing money from your pension has never been more flexible and more easy to do. So you're right. There's a huge change, and technology has been a big part of that for sure. So getting access to lower cost pensions, and within those pensions, much lower cost funds, which you might call index linked funds or tracker funds, or sometimes they're called ETFs, exchange traded funds. They're different types of low cost funds, so we won't get bogged down in the detail, but very, very low cost fund options that give you access to a really broad range of stocks and property and gilts and bonds and all the things that make up a sort of a broad stock market based investment portfolio for very, very low cost.
Yeah. And most people, of course, think that, pensions are invested in the markets and that's it. But are there any alternative strategies that other people can think about?
Well, there absolutely are. And again, coming back to this contrast between a basic pension and a director's pension or a SSAS, the difference is light and day, because a basic pension is geared up towards investing in the stock market. And though you may have many, many hundreds or even thousands of different funds and ETFs and things that you can choose from, it is still just a single strategy, and that's the stock market. And, undoubtedly you and Kevin would have covered this, I'm sure, many times over, but there's a huge danger in all of your pension wealth, in fact, generally speaking, all of your wealth relying on just a single strategy, of course. And there are, I would say, at the highest level, at least 4 different strategies that a pension can use if you have the right vehicle. Do you want me to cover them?
Yeah, please do.
Okay. So obviously, even functional, flexible, powerful pensions can do the stock market thing. And there's a place for that in all pensions. We're big advocates here at WealthBuilders about, diversifying your wealth and making sure that you have multiple streams of income. And that comes from having multiple strategies, usually. But SSAS or director's pension, just like a personal pension, a basic pension or a SIPP, can do the stock market thing. And in truth, actually has the widest possible range of funds and the widest possible range of platforms that it can hold those funds on. Okay, so that would be strategy 1. The second strategy would be commercial property. And I'm talking about here becoming a commercial property landlord, and actually using your pension money to purchase any different kind of commercial property and getting the long-term benefits, broadly speaking, that commercial property offers. And of course, we don't really know what the future of commercial property will look like exactly. I'm sure, like in all big worldwide occurrences, there are always changes, and it may well be that there's huge opportunity in commercial property in the coming months and years. But you're buying a physical asset that doesn't react in the same way as the stock markets do. You've got regular recurring income, so definitely something that could be considered. Of course, even additionally to that, you've got, in certain cases, especially as I say with the SSAS, you've got the ability to even take property skill that you might have to do developments inside a SSAS too. So you can take either skill you've already got in property or skill you can be taught and translate that into making your pension work harder in that area.
Okay.
So that's number 2. Number 3 would be taking some of the money that your pension has and actually using it within your own business. Now, that is unique and rare. It's specific only to SSAS. It's something that only a SSAS can do, which is what makes it such a powerful tool for business owners. But actually being able to tap into your own pension in a time where, the world is a very strange place at the moment. Lots of businesses sadly have failed. Lots need propping up. These bounce back loans and government incentives, furlough schemes and so on are really designed to try and shield and protect the best businesses and good quality businesses from failing. But why look to a bank for a prop-up loan when you can look potentially to your own pension and actually tap into some of your own money to help grow your business, after the COVID pandemic. And that, actually doesn't matter what industry you're in, whether you're in property, in manufacturing, in retail, it doesn't matter. The ability to borrow your own money is there if it's going to genuinely boost what your business does. And then the fourth thing is I guess what we'd call becoming the bank, and actually becoming a source of leverage and bridging for other people's businesses. And if you've got the right type of pension, you can actually lend out some of your own money, and you can lend it to any legitimate business as long as you're not connected to that business. And you can lend it sometimes to individuals too. So you can actually, in a way, help become part of the bounce back solution with your own pension, if you think of it that way. You could be providing loans to small businesses to help them grow and to help them come back from COVID. And of course, you have to be careful. It goes without saying that, lending is more complex than any of the other strategies we've talked about. But can be a huge boost to your wealth, is a very different type of asset class and strategy to the stock market and directly owning property, of course, but, could definitely add some value to people, especially if, from an ethical point, people like the idea of helping and supporting other businesses. And it's a great way of, helping and supporting small businesses too. Mm.
Well, for anyone that perhaps has not heard of the director's pension before, I think you might have just slightly blown their mind with some of those things, Paul.
Well, I hope so. It genuinely is what I would call an exciting pension, and there's not many type of pension you can talk about there. You would use the word exciting in the same sentence. I'm sure you'd agree.
Yeah, and we often say this, but the pension really can be the fuel to power so many of the other pillars. And you've just talked about the property pillar there, as one of the main ones. Joint venture pillar, you can work with your pension, obviously, in that pillar as well. Business pillar, you've just mentioned as well. So it really can work, very, very well as part of your overall wealth plan, and certainly not something that you should just be thinking that you can't tap into until you're 55 or beyond.
Well, I mean, you absolutely hit the nail on the head there, Chris. There's this misconception that pensions are this thing that gets locked away in a box, and sometimes even until you're 60 or 65. And, as we talked about earlier, pensions are much more flexible when you're 55 or over in the UK. Currently, at least, you can start tapping into some of your pension benefits. But particularly with the SSAS, as I said, if your business is looking for funding to grow, then you can get access through the business into the pension, some of the pension capital. And there's a huge amount of synergy between director's pension, SSAS, and all of those pillars, as you just said. There really is. It's almost like a facilitator to grow lots of the other pillars. It's a tool that you can call on that actually helps boost your pension pillar and your business pillar and other people's business pillars too, which is what makes it so exciting, I think.
Yeah. So I guess to summarise then, Paul, and again, tying it into the circumstances that we've seen over the last few months, is just, always have that longer wealth term plan, that long-term view, really, because wealth is not created in 12 months or even a few years. It's a long plan, and we've seen that the markets go in cycles. We know that we'll have another period like we've seen recently, and that you should have a cool head. And this was echoed by Manish as well when we were talking about the investment pillar last week. And where possible, reduce your charges, reduce the costs, and manage and control your pension as best that you can. And for those people who perhaps are business owners, they may want to have a look and understand more about the director's pension and see how that can help them to really accelerate their journey.
Absolutely. I'd really encourage it. Business owners are uniquely able to tap into the power of a SSAS, and even if they don't necessarily use it to borrow their own money into their own business, there's a whole wealth of things that we've just touched on very, very quickly. But, really That's the ultimate high performance pension vehicle. But even if you're not a business owner now, or you don't ever aspire to being a business owner, it certainly doesn't mean that you shouldn't be wanting to take more control over your pension. And, just to quickly recap, those two things, as you just said, one would be really get control of the costs. Do what you can to minimize your costs. And that might mean reviewing the current pensions that you've got, spending some time with a good financial advisor to really find out if you can minimize the impact of your ongoing costs. But also actually have a proper plan to manage your pension. Don't just do some good work at the beginning and minimize your costs and then do the same that you've always done if that's what you do, and that's leave it in the filing cabinet and you go into the same routine. Have a proper process of reviewing, whether that's on your own or whether it's with a fund specialist, a financial advisor who can really help you manage and update and change your plan as you move through, I guess the key stages in your life, but certainly at least on an annual basis, you would want to be reviewing pension wealth.
Brilliant. Paul, it's been great to have you on Wealth Talk today. Thank you so much.
Pleasure. Thanks, Chris.